Okay. So before we get started, I have a very important rule that I need you all to follow throughout this entire session. And the rule is very simple. Throughout the entire session, I'm going to be asking y'all a bunch of questions. Now, when you give me answers to these questions, I want y'all to be completely honest with your answers. Can y'all do that for me? Yes. Yes, can we have this agreement? See, I don't want you all to sugarcoat your answers. See, I have no clue who you are. None of these other people know you. So there's no reason for you to think that, okay, these people might judge me based on my questions. Right. So please don't feel that way. I want complete honesty in your answers whenever I'm asking you questions. Please be very honest. Right. And see, one thing which is very important for me is whenever I'm teaching something, it is especially about chart reading. I hate it if it's just rule based. As in, if I'm telling you, okay, do this, so market goes up, down, and you enter here, exit there. Now, I don't want you all to just think whatever I'm teaching in terms of these rules, XYZ rules. No, that's not the reason why we are here. We are here to understand the logic of exactly what's happening in the market. And to understand the logic, it is very important for you to keep asking questions if you feel like you're confused in between. All right. Now, guys, yes, can we have these yeses? Can we have this agreement among us? Very honest with your answers. Yes. Now, again, please do let me know if I'm overcomplicating if a little a few things. Some of the things might seem a little complicated. So if at all it does seem complicated, please make sure you ask your questions. Again, another thing that I'm going to guarantee you is I'm not going to end the session without making sure all the questions are answered. Okay. Perfect. Now, question number one, guys, how many of y'all are completely new to stock trading, not investing, to stock trading? If you're new, type new, or if you've been trading for 2 years, type 2 years. If you've been trading for 6 months, type 6 months. Go. 6 months, 1 year, 2 years, 6 months, 6 months, 1 year, 3 months, 6 months, 4 years. Okay, so a few. I think majority of y'all are new, which is also fine, right? I'm going to be teaching from scratch. Either ways, 5 years, but still not a problem. Not a problem. 5 years and still losing money. That's not your fault, right? You still do not understand what you're supposed to be doing in the market. Whatever you've been doing for the past 5 years is wrong. I'm sorry to break that bubble of yours, but then you are looking at the wrong things in the market, right? Guys, is the chat a distraction? Do you all want me to turn off this chat in such a way that only I'll be able to see the messages? Is it distracting? Okay. Okay, wait. So one second. Okay. So see, now you can still chat, but then only I'll be able to see your questions. All right. So it won't just keep popping in your screen. I think the other way around is a bit of because I see a lot of chats happening. Cool. Turn on camera, dude. I'm not in my office, right? So for unfortunately, you won't be able to see my beautiful screen. But once you start live trading, you'll see. Don't worry. Right now, okay. Now, guys, quick question. I'm gonna name a few concepts. Type yes if you understand this concept properly. Type no if you do not. Okay, we'll start with the basics. Number one, um, market structures. Your higher high, higher low for uptrending structures, lower high, lower low for your downtrending structures. Type yes if you understand this concept. Type no if you do not. Very basic. Yes. All right. Perfect. Basic. Right. Now, yeah, it was covered in yesterday's session, if I'm not wrong. Number two, support and resistance. Type yes if you understand this concept properly. Type no if you do not. Okay, I see a few no's. What about breakouts? Again, another very basic concept. Breakouts? Yes, no? We're good on breakouts. Okay, I see a few no's. Um, what about liquidity, imbalance, price delivery? Okay, done. Perfect. So everyone understands market structures, so I'm not going to touch market structures again, guys. Very simple, right? Very simple. You'll already understand how market moves. It moves in swings, right? It creates higher high, higher low, higher high, higher low, higher high, higher low, higher high, right? So this is basically how your structure looks like, right? It's very basic. Now we're gonna start with support and resistance. Support and resistance. What is a support? What is a resistance? Let's try to understand. Now, guys, imagine 1 second. Today is about intraday, right? See, the you know what the good part about what I'm teaching is markets are fractal in nature, right? There's fractality in the market, which means whatever I'm going to be teaching you, if I'm teaching you something in the 1 minute time frame, that applies exactly the same in 3 minute time frame, 5 minute time frame, 15 minute time frame, 30 minute time frame, 1 day time frame, 1 week time frame, right? Does not matter. Market is fractal. So if at all, if you've been trading for quite some time, and if some of your wherever you've learned from, if that person has taught you a particular strategy for one time frame, and if that strategy does not work on all the time frames, then I'm sorry to say this, but then that strategy is a very bad strategy, right? That is not how the market should function. Market is fractal. So if something should work in 1 minute time frame, it should work exactly the same in 30 minute time frame as well, right? So it is not for just intraday, right? So if I'm teaching you a system, if I'm teaching you all to do this in 3 minute time frame, the same exact thing, if you do it in the higher time frame, it becomes what? It becomes a swing trade. Get it? That is the good part. No, but don't worry, we'll get to all that later. Let's not overcomplicate stuff right now. Now, guys, what is a support and what is a resistance? And the people who already understands these basic concepts, guys, please give me the next 10 to 15 minutes. Don't worry. Even if you've been trading for 3 5 years, don't worry. You are going to be learning so much more, right? So please wait while I explain the basics. Okay. Now, guys, imagine you are this person right here. Okay, that's you. This is you, and you are holding a ball. That's you holding a ball, and what you're doing is you're standing in front of a wall. That right there is a wall. Now, what you're doing is you're throwing this ball onto the wall. You're throwing the ball. So what happens after it hits the wall? It hits the wall and it'll bounce back. Correct? It'll hit the wall and it'll bounce back. Now, exactly the same way, in the stock market, there are imaginary walls that exist. For the time being, let's call it imaginary walls. In the stock market, there are imaginary walls where the price comes, hits the wall, and it bounces back. Okay, let's try to look at some examples. So I'm going to draw an imaginary wall like this. I'm going to draw an imaginary wall, right? Now you already understand that price moves like this, right? It's pretty random, right? But for some reason, in some situations, you will find the price go up and tap into some random imaginary wall and it will bounce back. And at the same imaginary wall, it will tap once more and then again bounce back. It will again tap, again bounce back, again tap, again bounce back, right? Now, this imaginary wall that you see right here is called your resistance level. Okay? This imaginary wall that you see right here is called your resistance level. Now, why is it called a resistance level? Let's try to understand. For example, let's imagine that this particular wall is sitting at 50 rupees or 100 rupees. Okay, this wall is sitting at 100 rupees. Now, every time, let's assume the price here starts from maybe 80 rupees and it's going up, right? But every time it taps into 100, for some reason, it is hitting this imaginary wall and it's bouncing back down. Again, it hits 100, it bounces back down. It hits 100 and it bounces back down, right? Now, would you agree if I say that every time market tries to go above 100, something is resisting the price from going above 100? Can you agree with my statement? Something is resisting the price from going above 100. Would you agree with my statement? Right? That makes a lot of sense. Now, that is exactly the reason why this right here is called your resistance level. Now, that obviously means that something is happening at 100, right? Someone is selling here. Something is happening here. Every time market goes up, some buying is happening and market is heading higher. Some selling suddenly randomly comes here at 100. That is exactly what's happening, and that is the reason why we have a resistance level, right? Now, if this right here is your resistance level, guys, what is the name of our topic? Our topic was support and resistance, right? Now, resistance, though, you understand. You already know what a resistance is. It's an imaginary wall. It happens at the top. Every time market tries to break above a particular price point, it resists the price from doing so, right? That is exactly what a resistance level is. Now, what is a support level? Very easy. It's exactly the same as support level, but instead of it being at the top, support level will be at the bottom. As simple as that. For example, I am going to draw another imaginary level right here. And let's assume this imaginary level is sitting at not at 100, but at 50 rupees. Okay. So every time price comes down to 50, it taps into this imaginary wall, bounces back, taps into the imaginary wall, bounces back, taps, bounces, taps, bounces, right? Now, this imaginary wall that you see right here is called your support level. Very simple. Now, why is it called a support level? Again, would you agree if I say that every time price tries to go below 50 rupees, the market is supporting the price from falling any further? Would you agree with my statement? Yes or no? Market is supporting the price from falling any further than 50, right? Because why? For some reason, market is finding support here, support here, support here. And what does that mean? Some buying is happening. Some buying is happening here, buying is happening here, buying here, buying here, right? Now, that is exactly what your support level is. Now, guys, type yes if you understand what a support and resistance level is. If you are very clear on what on the distinction between the both. Now we are going to play around with this. We are going to dig deep into understanding a little bit more into support and resistance. Now, if you look at what I've already explained, the support and resistance levels that I've drawn, it's all horizontal, right? It's horizontal. It's horizontal, right? But the thing is, your support and resistance levels does not necessarily have to be horizontal all the time. It doesn't have to be horizontal all the time. It can be slanted, right? It can be slanted. For example, let's assume we have a slanted resistance, which means price will take resistance here, take resistance here, take resistance here, take resistance here, take resistance there, right? Now, but the only difference when it comes to your slanted resistance is that this is no longer called your resistance level. It's called your resistance trend line. It's called a resistance trend line and not a level. Now, why is it called a resistance trend line? Because whenever you have a trend line, when you look at it, you kind of understand the trend in which the market is trying to head towards, right? For example, would you say that this right here is in an uptrending structure, or would you say it's a downtrending structure? It's obvious that this right now is going in an uptrending structure, right? So whenever you have a slanted resistance or support, you kind of understand the trend of the market. And that is exactly the reason why it's called a resistance trend line and not a level. What are levels? Levels are horizontal. Okay. Now, guys, let me ask you this question. If that right there is your resistance trend line, what is that? If that right there is your resistance trend line, what is that? Is that your support level or is that your support trend line? Exactly, that right there is your support trend line. That right there is your support. That right there is your support trend line. Clear? Now, before I show this to you all in chart, type yes if you understand the theory of what a resistance and what a support trend line and levels mean. Clear? Perfect? Awesome. Great. Good. You all are fast learners. Perfect. Awesome. Now, guys, quickly, what is that? What did I just plot right now? What did I just plot right now? Is that a resistance level or is that a resistance trend line? What is it? Exactly that right there is your resistance trend line, right? Guys, what is this? What is that? What is that? What did I just plot right now? That is a resistance trend line. Awesome. Perfect. Now, I'm trying to find support trend lines. Again, this right here is again another resistance trend line. Again, another resistance trend line. Guys, what did I just plot? What is that? What is that? That right there is your support trend line. Right? Now, what is that? Perfect. Now, guys, if those are your slanted support and resistance levels, what is that? What is that? Is that a trend line or is that a resistance level? That right there is your resistance level. Clear? Now, guys, type yes if you will be able to plot all this by yourself. Next time you look at the charts, your support and resistance levels. Is it an easy thing to plot? Is it an easy thing to plot? Yes. Perfect. Perfect. Do you all want me to keep giving examples or do you all, can I continue? Do you all want more examples? Cool. What is that? What is that? That right there is a resistance level. Perfect, perfect, perfect. Right? Now that you understand what resistance and support levels mean, see the reason I'm skipping faster in this concept is because these are hardly relevant to what you'll be doing, right? Your resistance levels and support levels hardly matters, right? You'll understand what I'm. One second, guys. Someone told me that it's asking for a password. Is it asking for a password when you join the session? It's not, no? Okay. All right. Okay, never mind. All right. So now that you understand support and resistance levels, now I'm going to introduce you all to a new concept, which is called breakout. It's called breakout. Now, again, again another very easy concept, extremely easy concept. It's a very basic concept. Now, what exactly is a breakout? For example, I'm again going to plot an image. Okay, I'm not going to call it imaginary levels anymore. I'm going to draw a resistance level. And let's assume this is how the market is moving, right? Let's assume market is doing something like this. This is how the price is moving. So this is what we call volatility contraction pattern. All right, this is something called VCP. Now let's assume market is reacting to our resistance level. It's forming a resistance level, and it breaks out of your resistance level. It breaks out of your resistance level. The process of market breaking out of your resistance level is called a breakout. Is that clear? Is it a very easy concept? So technically, as per the textbook definition of price action trading, after a breakout, you are expecting the market to continue heading higher. Okay. Now, similarly, now I'm going to ask you a question. If breakout is the process of market breaking out of a resistance level, then what do you think is a breakdown? What might be a breakdown? What is a breakdown? What do you think is a breakdown? Exactly, right? If that right there is a breakout, if breakout means market price breaking out of your resistance level, breakdown is nothing but you having a support level. Again, market is contracting at your support level, and then it breaks down, right? So the process of market breaking down from your support level is called a breakdown. But technically, it's wrong, because it's not called a breakdown, it's called a support breakout. Okay, both are called breakouts. I don't want you all to be calling this breakdown, because that's a wrong term. There is nothing called breakdown. It's either a support breakout or we have a resistance breakout. Both are breakouts, right? So if it's breaking out to the upside, it's called a resistance breakout. If it's breaking out to the downside, it's called a support breakout. Is that clear? Now, can I show you all examples? Guys, can I consider this as a resistance breakout? Yes or no? Is that a resistance breakout? So what's happening here? Market is forming a resistance. It's taking resistance, and then it breaks out of the resistance and heads higher. Right? Now, similarly, let's see here. Can I consider that as a resistance breakout? Can I consider that as a resistance breakout? See, time frame does not matter. Time frame does not matter. It works exactly the same in all the time frames. For example, see, right now I'm in a 2-minute time frame. Do you all want me to switch to a high time frame? Right now I'm in 15-minute time frame. Okay, right now I'm in 15-minute time frame. Now let's see here. Can I consider this as a resistance breakout? Can I consider that as a resistance breakout? Perfect. Right? So your time frame does not matter. Can I consider that as a support breakout? Yes. Now type yes if you understand exactly what a breakout is. Clear? Very clear, very easy concept. Yes. Perfect. Perfect. Now, correct. That's a support breakout side. Now, I'm again going to plot. So this is where things will start getting interesting. Okay. I'm again going to plot a resistance level right here. And then again, market contracts. And then we have a breakout. Okay. Now, how many of y'all understand what price action trading is? Price action trading. Do we have any price action traders here? Type yes if you all have been trading price action. Any breakout traders here? Type. You all trade chart pattern breakouts, trend line breakouts. Yes. Breakout and retest, whatever the case might be. Okay, I see quite a few. All right. Now, what exactly is price action trading? Before we move forward, it is very important for us to understand what price action trading means. Right? Now, for us to understand what price action trading means, we need to understand the different types of market participants existing. Now, there are two types of market participants. One are institutional traders and investors, and then we have retail traders and investors. In which category do you think we fall in? Are we retail traders or investors, or are we the institutional traders and investors? Obviously, we are retail traders, right? Now, guys, who moves the market? Who do you think is responsible for making the market go up, down, up, down, up, down, doing all this? Is it the retailers, or do you think it's the institutions? Exactly, it's obviously the institutions. And who are the institutions, guys? Institutions are the big banks, right? The Goldman Sachs, LICs, the Vanguards, the Black Rocks of the world, the big hedge funds, right? People with huge amount of capital at their disposal, those people are the institutions, and institutions are responsible for moving the market. Now let me ask you a question. So right now we have around some 500 people attending this session. Now, if all of us start one Telegram channel and we all open Reliance and we are all coming together saying, let's all buy Reliance together at this particular time, do you think we'll still have enough money to move the market? Obviously not. So I want you all to understand the amount of money which is required to move the market. It is extremely high. For example, whenever I'm trading futures, right, I am punching in orders in Nifty futures worth 65 lakhs. And when I even put market orders, the candle doesn't even flinch. So imagine the amount of volume which is being played around in the market, right? So it is very, what we've established is that it's very obvious that the institutions are responsible for moving the market, right? Now, now we are going to talk about retail traders. Now there are retail traders. Retail traders are people like us. And one thing that I need you all to understand about retail traders is that 90% retail traders currently trading in the market trades price action, trades a concept called price action. Now, I'm going to explain what price action trading means. Price action trading is a system which involves entirely on breakouts. For example, we have this breakout right here. As per the textbook definition of price action trading, right after market breaks out of your resistance level, you are supposed to buy at the breakout. Exactly when the breakout happens, you are supposed to buy at the breakout, or some people might wait for the retest and buy here. Doesn't matter. So the idea is, as per the textbook definition of price action trading, whenever market breaks out of a resistance level, market should end up heading higher. This is the textbook definition of price action trading, right? Can the price action traders agree with this? Is this what you are taught to learn? Sorry, is this what you are taught to do? You wait for market to react at some sort of levels, and then you wait for it to read to break, and then you look for volumes and candlestick confirmations, and then you buy. Yes, 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 yes. All right, perfect. Now the problem here is 7 out of 10 times. 7 out of 10 times. After market breaks out of your resistance level, instead of going up, market goes down. Now I'm going to disable the chat just to see, just so that everyone can see if this is true or false. Sorry, enable the chat. Guys, will the price action traders agree with me when I say that 7 out of 10 times your breakouts fail? Type. I need the price action traders to type. 7 out of 10 times your breakouts fail. Correct? Now, it is very important for us to understand why all this happens in the market. Extremely important. Now, the problem, see, I hope you understand the problem. 90% retail traders currently trading in the market, they are trading price action. And the problem with price action trading is that 7 out of 10 times your breakout, instead of heading higher, it goes back down after the breakout, right? Which means if you're a price action trader, you are basically trading a system with a 30% win rate, which is a very bad win rate, correct? Now, here is where things get a lot more interesting. If this is the case, right? If 7 out of 10 times your breakouts fail, would you rather buy at the breakout or would you rather sell at the breakout? Would you rather buy at the breakout or would you rather sell at the breakout? Because technically, if you think about it, instead of buying, if you sell at the breakout, now you automatically have a 70% win rate. Correct. Logically, that should make sense, right? Because if 7 out of 10 times breakouts fail, so instead of buying at the breakout, if you just sell at the breakout, then you should have a 70% win rate this time, right? But do you think that's how market functions? Do you think market is as easy as just selling every time a breakout happens? Absolutely not. Absolutely not, right? Now, for that reason, it is very critical for you to understand exactly what's happening here. Now, that is what our focus for this session will be. I am going to make sure you understand exactly how the market moves, the reason why the price goes up and down, the reason why the price does whatever you see on charts. That is what we are going to break down in this session. And obviously, I'm not gonna leave you without teaching you all a system to trade with, right? So that's also there. Now, for us to understand why all these things are happening, right? So see, guys, the process of your breakouts failing, it's called a fake breakout. It's called a fake breakout. What is a fake breakout? Market initiates a breakout, but ideally it should head higher, but then what ends up happening? It comes back down. right? The breakout fails. And that is the reason why it's called a fake breakout. Can we use this system in Forex? Yes. So the thing is, whatever I'm going to be teaching you will work on every financial instrument that can be represented in candlesticks, which means you can use this system to trade Forex, crypto, US market, doesn't matter. Every financial instruments, the institutions, how they pump in and out the money is exactly the same across all the instruments. All right. So I hope you keep that in mind. Now, for you to understand why all this happens in the market, it is very critical for you to understand something called liquidity. This is where we are officially going to get started. I hope you all are excited. Now, what exactly is liquidity and why is liquidity that important for us? Can anyone tell me what liquidity is? I'll be very impressed. Guys, all my followers, y'all better get this question right. What is liquidity, guys? Type. At least, bro, if you're following me, if y'all don't know this, means I'm gonna give you one kick. What is liquidity? Quickly. Money, order. Okay, I see. Okay, good. Buy stocks. Not necessarily. See, again, that is another. See, all these people who doesn't understand the logic, people are selling liquidity is just buy stops and sell stops. No, that's not it, right? That's not what liquidity means. It's not just SL levels. What exactly is liquidity? Now, guys, to put it in very simple terms, liquidity is nothing but pending orders in the market. To put it in very simple terms, liquidity is nothing but pending orders in the market. Now, what do I mean by that? What do I mean by pending orders in the market? Now, I'm going to take an example. So, let's assume this right here is the chart of Tata Motors. Okay. This right here is the chart of Tata Motors. And currently, let's assume currently Tata Motors is trading at 100. All right. Currently, the current price is 100. Now, guys, I'm watching Tata Motors and I'm doing all my analysis and I'm able to understand that, okay, Tata Motors has to go up until 200. For some reason, I'm able to do this analysis, right? I'm able to figure out that, okay, Tata Motors in the next coming few days, it should go to 200, right? I'm just giving a very basic example. Now, if that is the case, what will I do? I'm going to start buying shares of Tata Motors. Correct. Now, what will I do? So currently, when I'm opening the market, what is happening? Currently, I can see the Tata Motors currently trading at 100 rupees. So what do? I open my Demat account. I open my broker, whether be it Zerodha, Fire, Substocks, doesn't matter. I open my broker. I click on quantities. I type in 50 quantities and I click the buy button. Now, when I'm doing this, the broker and in the broker, when I'm putting 50 quantities and I'm clicking the buy button, what is actually happening? Is the broker responsible for giving me these shares? Or is that the stock exchange who is responsible for giving me these 50 shares of Tata Motors? Is it the broker or is it the exchange? Is it NSE? Obviously, it's the exchange, right? Broker is only an intermediary, right? So what is the broker doing? Broker is taking the signal. What is the signal? That I want to buy, this person, Ritvik right here, wants to buy 50 shares of Tata Motors. And this order is being filled by the stock exchange. I hope that is very clear. Now, again, coming back to what I'll be doing here. Currently, the market price is 100. And I want to buy 50 shares of Tata Motors at 100. I want to buy I want to buy 50 shares of Tata Motors at 100. Correct? Now, guys, would you agree with me if I say that for every buyer, there has to be a seller? Would you agree? For every buyer, there has to be a seller. For example, let's assume we have a buyer here, we have a seller here, and this right here is a fruit store. Inside the fruit store, there are apples being sold. Buyer goes to the fruit store and he's like, boss, listen, I want to buy 100 apples. But let's assume the seller is only selling 5 apples. How many apples can the buyer actually buy? Type. Exactly, the buyer can only buy 5 apples. Why? Because the seller is only selling 5 apples. Correct. Now, exactly the same way, let's try to think of it in reverse. Let's assume the seller wants to sell 100 apples and the buyer only wants to buy 5 apples. Now, can the seller sell these 100 apples no matter how hard the seller tries? How many apples can the seller sell in total? Seller can only sell 5 apples. Why? Because only 5 buyers are there. Because buyer is only ready to buy 5 apples, right? So it should be very obvious that the number of buyers, sorry, it should be very obvious that for every buyer there has to be a seller, and for every seller there has to be a buyer. That is extremely logical, right? Now, guys, if that is the case, for me to buy 50 shares of Tata Motors at 100, what is my requirement? I need someone who is ready to sell 50 shares of Tata Motors at 100. Would you agree? For my buy order to go through, to be successful, I need this particular seller. I need a seller who is ready to sell me 50 shares of Tata Motors at 100. For some reason, let's assume when I'm clicking the buy button, there is no one who is ready to sell. Let's assume this seller is not there. Will I be able to buy? Will I be able to buy shares of Tata Motors? I won't. Right? Why? Because who is going to sell it to me? There is no one to sell it to me. So even if I want to buy, even if I press the buy button, my order will not go through. Why? Because there is no one to sell it to me. Right? Now, but we all know that, I hope you all have at least once bought one share. Guys, type yes if you have ever done some sort of investing, bought one share, anything in the market. Yes, yes. Oh, you all have that much little of information about the market. So you guys already know that whenever you click the buy button, instantly your order gets placed. Correct? The moment you press the buy button, no matter what quantities you press, whether be it 50, 100, 200, 500, doesn't matter. No matter how many quantities it is, whatever price it is, the moment you click the buy button, your trade is immediately executed. That means the stock market is somehow immediately finding sellers for you. Would you agree? So somehow market is able to find sellers for your buy orders immediately. Instantly, it's able to find you sellers. Correct? Because every time we press the buy button, our order is getting executed. Now, for our order to get executed, what do we need? We need sellers. Correct? So, but we all know that whatever stock we want to buy, whatever the company is, whatever the number of shares is, whatever the price is, the moment we click the buy button, we can immediately start seeing it in our PNL. If price goes up, we'll start seeing our profit. If price goes down after we buy, we can start seeing it in loss, right? But the fact of the matter is, immediately we'll start seeing it, seeing our order in our PNL, right? Now, doesn't that mean, if you think about it, doesn't that mean that every time you buy, at whatever price, it doesn't have to be 100, let it be 110, 15, 20, doesn't matter. Whatever price you want to buy, how much ever quantities you want to buy, for some reason, you are always able to buy a seller who is ready to sell to you. Doesn't that mean, if you think about it, doesn't that mean that throughout the entire price, at all the price points, there are imaginary sell orders waiting to be executed? Would you agree with my statement? At all the price points, there are imaginary sell orders just sitting there waiting to be executed. When does those imaginary orders get executed? The moment you press the buy button. The moment you press the buy button, these imaginary sell orders will get executed. How many of you have understood this logic? Type yes. Is that clear? Okay, perfect. Perfect. Right? So what I needed to understand is that every time, whatever the price you want to buy, right? If you want to buy here, buy here, buy here, buy here, does not matter. The moment you press the buy button, you are somehow able to find a seller. Again, if the price goes up, if you want to buy here, you are immediately able to buy because you again find a seller. If you want to buy here, you are able to buy because you are again able to find a seller. That means at all the price points, there are a lot of sellers just sitting there waiting to be executed. Now, again, let's look at the same Tata Motors example, right? What was I initially planning to do? Price was currently sitting at 100. And my idea was I'm going to buy 50 shares here. I'm going to buy 50 shares at 100, which means I need someone who's ready to sell me 50 shares at 100. And let's assume the price goes all the way to 200. Now, when it reaches 200, I need to sell, right? I'm going to sell for profit, right? Which means once it reaches 200, I'm going to sell it. So what is the order that I'll be putting in? I'll be selling 50 shares of Tata Motors at 200. Now, guys, for this order to go through, what is my requirement? For this order to go through, what is my requirement? For my sell order to go through, what is my requirement? Exactly. I need a buyer who is ready to buy 50 shares of Tata Motors at 200. Correct. And we already know that we are able to sell wherever we want. We don't have to wait till 200. We can sell it maybe 110, 115, 117, 118. We can sell wherever we want and our order instantly goes through. Doesn't that mean that at all the price points, there are imaginary buy orders as well? Would you agree? So if you think about it, the entire market, the entire market the entire market is filled with a bunch of buy, sell, buy, sell, buy, sell, buy, sell, buy, sell, buy, sell orders. Would you agree? Type yes if you understand this logic. The entire market is filled with imaginary orders waiting to be executed. Now, these imaginary orders in the market is called liquidity. The availability of these imaginary orders in the market, these pending orders in the market, is called liquidity. Now, before we move forward, type yes if you understand exactly what liquidity means. Clear? Perfect. 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 Awesome. Now, so what have we established so far? It means what we have established so far is that market is filled with liquidity. Market is filled with pending orders. We have established that already. Now, in some areas of the market, there will be much more liquidity, much more pending orders compared to other areas of the market. Don't worry, I'll explain. In some areas of the market, there will be much more liquidity compared to other areas of the market. For some reason, I'll tell you the reason, don't worry. Right? In some areas of the market, there will be much more liquidity compared to other areas of the market. Now, here comes the rule number 1 of price behavior. The rule number 1 of price behavior states that market always moves in search of liquidity. This is going to be your bread and butter going forward. Please take a screenshot of this and type done once you're done taking the screenshot. Market always moves in search of liquidity. This is the rule number 1 of price behavior. Type done once you're done taking the screenshot. Perfect. Perfect. Now, if that is the case, if you understand this rule, let's assume this is how the market is moving. Market goes up and absorbs all this liquidity here. Now, where do you think the market is likely to head towards next? Will it go up or will it go down? What do you think? If market moves in search of liquidity, exactly, it'll go down. It'll go down, absorb all this liquidity. Now, where do you think it'll go? Will it go down or will it go up? Exactly, it'll go up, absorb all this liquidity, it'll go down, absorb all this liquidity, it'll go up, absorb all that liquidity. Now, the only question that you have in your mind is that if we are able to somehow understand where these pools of liquidities are present, you will kind of be able to understand where the market is trying to head towards, correct? If you are able to understand where these pools of liquidity are present in the market, you are able to understand where the market is likely to head towards next. Correct? Now, that is what we are going to understand. That is what we'll be learning in the next concept. Now, we are going to understand, we're going to try to learn and figure out where we'll be finding these pools of liquidity in the market. Cool? Now, for you to understand this concept, let's again go back to retail trading and price action. Okay. Now, I'm again going to plot a resistance level. And this right here is a breakout. Now, guys, would you agree with me if I say that, okay, again, something that we've already established is that 90% retail traders does what? They trade price action, which means they trade breakouts, right? Now, if that is the case, would you agree if I say that a lot of people would be buying at the breakout? Would you agree? A lot of liquidity would be coming right at the breakout. A lot of people would be buying here. Why? Because they are expecting the market to head higher so that they can sell for profit. Right? A lot of people would be buying exactly when the breakout happens. Right? So let's assume at the breakout, 100,000 buyers came in. Let's assume 100,000 buyers came in exactly at the breakout. Now, guys, would you agree if I say that all these people who would have bought here, they'll be keeping a stop loss? Right? They'll all be keeping a stop loss as well. Right? All the people who would have bought there, they have to keep stop losses. Right? So let's assume all these people who would have kept their stop losses below the swing low, right? Because that is only some people keep their stop losses right there, which is very stupid. So let's assume for a minute that majority of the people are keeping their stop losses below this swing low right here. So guys, if all these people are buying here, their stop loss order, is it going to be a sell order or is it going to be a buy order? It is going to be a sell order, right? Because they want to exit. So all these people who would have bought here, they will be keeping their stop losses right below this below this swing low right here, right? Now, would you agree if I say that there will be 100,000 pending sell orders waiting here? 100,000 stop loss sell orders pending there waiting to be executed. Would you agree? All these people who would have bought here, they themselves will create another huge pool of sellers liquidity. Now, if you think about it, now that you understand the rule number one of price behavior, from here, where do you think is the market is likely to head towards? Will it go up or will it go down? Will it go up or will it go down? Exactly, it'll go down. It'll go down and absorb all this liquidity, right? Now, if you, again, all these people, if you that bought here at the breakout, did they make money or did they lose money? All the retail traders who bought here, did they make money or did they lose money? They obviously lost money, right? So now you kind of understand one reason why 7 out of 10 breakouts fail. Correct? You understand one of the reasons why 7 out of 10 breakouts fail, but then still you don't understand why exactly this happens. You have a basic understanding of what liquidity is at the moment, but then you still do not understand exactly why this functions, right? So for that, we need a little bit more clarity. We need to understand a little bit more on how the institutions move the market. And that, and one second, don't worry, don't worry. All of your questions will be answered as I finish this concept. Don't worry. Now, that being said, now I'm gonna introduce y'all to something called liquidity engineering or price inducement, or to put it in very simple terms, manipulations. Have anyone heard of any of these terms before? Manipulations, I think some of y'all might have heard. Stock market manipulations. Have you all not heard? From my reels? Okay. Now, for you to understand liquidity engineering and price inducement, you need to understand how the institutions move the market. Now, guys, obviously institutions are placing huge amount of orders. Now, while we do it in brokers, while we are putting our quantities in broker, do you think LIC is also, LIC is the biggest institution of India? Do you think institution is opening Zerodha and putting a buy order for 100000000 and clicking the buy button every single minute? Do you think that is how these institutions are trading? So how do you think these institutions are placing their orders? How do you think these institutions are placing these orders in the market? Anyone? Block deals? No. Bulk orders? But no, how are they doing it? Where are they placing these orders? How are they doing it? Directly on the exchange, but how? How are they doing it? Do you think that there is some people? Do you think LIC is being handled by Raju from LIC? Sorry, do you think the entire money is being handled by Raju, or they have a team of people who will manually enter orders? Wrong. Now, institutions place orders by using something called high frequency trading algorithm. Now, what is a high frequency trading algorithm? I'm sure everyone understands what an algorithm is, right? Algorithm is basically a bunch of lines of code which is responsible, right? So all these orders are being placed by a bunch of lines of code. It's an algorithm, right? Now, but it's a high frequency trading algorithm. What does that mean? It means that institutions are placing orders left, right, and center every single minute. Every single second, institutions are placing buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. Every single orders are being placed in a high frequency. All right. So the institutions uses an algorithm to place their orders. And that algorithm is called a high frequency trading algorithm. Okay. Now, this part is already established, right? So from this moment onwards, I need you all to understand that institutions are placing orders by using algorithm. So this algorithm is responsible for moving the market. So whenever you see the market doing this is not Raju from LIC doing it. It's being done by algorithm. Algorithm is responsible for moving this, right? Now, coming to liquidity engineering. Now imagine I'm LIC. For a minute, imagine I am LIC. And my trading plan for the day is I want to sell 100,000 shares of Tata Motors. This is what I want to do as an institution. I want to sell 100,000 shares of Tata Motors. Now, guys, for me to sell 100,000 shares, what is my requirement type? What is my requirement? How many buyers do I need? How many buyers do I need? Exactly, I need 100,000 buyers. For me to sell 100,000 shares, I need 100,000 buyers, right? But now I'm going to draw the chart of Tata Motors. This is how the chart of Tata Motors looks like, right? This is how the chart of Tata Motors currently looks like. Now, here again, I need buyers liquidity, right? Because I need 100,000 worth of buyers liquidity for my order to go through. But the problem here is there might be 1.1k buyers here, 2k buyers here, another 3k buyers here, another 2k buyers here, maybe another 1k buyers here, another 2k buyers here, 5k buyers here, another 3k buyers here. Guys, do I have enough liquidity to place my order here? Do I have enough buyers liquidity for me to place my order here in this current market? No, I do not. So what will I do? I somehow want to sell 100,000 shares, but I don't have enough liquidity. Currently in Tata Motors, I simply do not have enough liquidity. So what will I do? I am going to do something called liquidity engineering. I am going to do something called price inducement. So what I'll do is I am going to print a fake pattern in Tata Motors. So I'm going to instruct my algorithm to print this particular pattern. So once I instruct my algorithm to do a price inducement, the market will print this pattern. Are retail traders familiar with this pattern? Are retail traders familiar with this pattern right here? What is happening here? What is happening here? It is forming a resistance breakout. Now, is it logical for me to assume that exactly at the breakout, there will be a lot of buying that happens? A lot of retail traders will start buying here at the breakout? Yes. A lot of buying will happen here. Guys, now do I have enough liquidity to sell my 100,000 shares? Now do I have enough liquidity to sell my 100,000 shares? Now, when all these retail traders are buying at the breakout, who do you think is selling it to them? When all these retail traders are buying at the breakout, who do you think is selling it to them? Exactly, the institutions, right? Now, you obviously understand what will happen next, right? What happens next? After the breakout, where is the next available liquidity? Where is the next available liquidity after the breakout? At the bottom, as the stop loss orders. So what happens next? Market comes back down, takes out all these orders. Now here, who actually made money? Institutions or the retailers? Now, what I need you to understand, exactly right, the institutions. So what I need you to understand is that market is constantly being manipulated. Institutions constantly manipulate the retail traders into providing them with the liquidity that they need to place their orders. I need you all to understand this. Market is always manipulating retail traders into doing something stupid for the benefit of the institutions. It is very important for you to understand this, right? Now, but if you think about this, doesn't this seem illegal? Doesn't this seem illegal? Doesn't it feel like these institutions are manipulating us? So technically, this should be banned. This should be illegal, right? SEBI should not be allowing this, but it's completely legal. This is completely legal. If the institutions does this, it is completely legal. But the sad reality is, if if a person does this, it's wrong. For example, if a company X, do you all know those stock market news TV channels like Z what Economic Times Live and Z Business and all those channels where there are these news anchors, expert stock advisors that comes in and give stock recommendations. Have you all seen those TV channels? A lot of up down Reliance, all these things will be going at the bottom. Do you all remember? Do you all see your uncles and aunties, your dads or mom watching these TV channels? So what happens is, I'll tell you what is illegal. CNBC, yes, right? So if the company X pays this news anchor some money, let's assume this company pays this news anchor 2 CR, and the company is like, boss, listen, say something very good about the company, right? So what will this news anchor do? News anchor will come on the TV and he'll be like, guys, everyone should buy into the stock X. The stock X has a very good upward potential. I'm expecting this stock X to go 40% in the next 3 months. All that bullshit this person will tell, and all these gullible investors, right? Like the majority of the people who are sitting at home, all our uncles and aunties, their main source of investment advisory are these news channels, right? So these these news anchors, when they give out, when they start saying good things about this StockX, what happens? A lot of people will start buying. A lot of people will start buying, and you know what will happen? Next day when the market opens, the stock X will go up like this initially. Now all these retail traders will keep buying, keep buying, and then it'll start tanking. So and this is basically what is called stock manipulation, right? But the problem is, if this gets caught, this news anchor gets put in jail by SEBI. This is illegal. But for some reason, when institutions does it, it's completely legal. And what do you say? So how they make sure this is not legal? So their argument is that we have to do this to provide liquidity in the market, because they can't justification exactly. Their justification is that they have to do this to provide liquidity in the market. They have to do this. Otherwise, institutions needs liquidity to move, and for market to bring in liquidity, the institutions has to do this, right? And that is completely legal. Now, can I show this to you all in chart exactly how this functions? Yes, by buying, right? Okay. See, the thing is, the amount of money which I put in, I'm LIC. So if I am putting, let's assume 10 lakhs to create this pattern, let's assume it costs me 10 lakhs to create this pattern. Once I sell here, during this move down, So I'll create this pattern. I've spent some 10 lakhs and then I sell everything here. During this move down, I would have recovered all the money that I have invested to print this pattern. That is how it functions. Cool. All right. Now, let's try to go into some examples. All right. I'm gonna give a very easy example for it so that it's easy for you all to follow through. 1 second. Let me look for example. A second. Would you agree if I say that a lot of people would have sold here thinking that it's a support breakout? Would you agree? A lot of people would have sold here thinking that okay, it's a support breakout and market is likely to head to the downside. Correct? So this right here, this pattern that you see right here, this is nothing but liquidity engineering. This is the institution manipulating the retail traders into thinking that market is going to head towards the downside. But what happens? So all these people who would have bought here, a lot of people who would have sold here, they'll all be keeping their stop losses here. Above that swing, they'll be keeping their stop loss. What happens? So who made money here? Did the retailers make money here or did the institutions make money here? Obviously, the institutions, right? Now, every time, majority of the time, when you plot your trend lines, right? For example, is it fair for me to assume that a lot of people would have sold here at this support breakout? A lot of people would have sold here thinking that market is going to finally start heading lower. A lot of people would have sold here at this support breakout, at this support trendline breakout. Yes. So what happens? What ends up happening? All these people who would have sold here, they'll all be keeping their stop losses here wiped out. Right? So next time, whenever you see the market break out of some sort of resistance or support levels, the general assumption that you'll be making is that market will come back down. The general assumption that you'll be making moving forward is that market will take this liquidity and come back down. Is that clear? From this moment onwards, every time you see a breakout, you are going to expect a reversal, not a continuation, a reversal. Now, before I move forward, type yes if you understand exactly what liquidity is, what liquidity engineering and price inducement means. If it's crystal clear, if you understand the logic, type yes. Clear? Perfect. Perfect. Now, that doesn't necessarily mean that every time there is a breakout, it has to come back down. Nothing of that sort. If the market is extremely strong, market will break and continue heading higher, right? So that is not relevant. This is not what I mean. The only thing that I'm trying to tell you here, the only thing what I'm trying to establish here is that you should never be buying at a breakout. Every time you are going to see a breakout, you are not going to buy here, you are not going to sell here. The general assumption that you'll be making is that market is going to absorb this by a buyer's liquidity here and then reverse. This is the general assumption that you'll be making moving forward. All right. Now, if that is clear, I'm gonna make a few changes into what we have already discussed. Now, guys, till now I haven't told you what to trade. This is not an entry criteria. I haven't told you. See, guys, this doesn't mean that every time you see a breakout, this doesn't mean every time you see a resistance level, you are supposed to sell here. No, no, this is not how you trade. I'm just telling you that every time you see a resistance level getting taken out, you are going to expect a reversal. That's all. This is just a general assumption that you'll be doing moving forward. That's all, right? Now, I'm going to make a few changes to what we have already 5 to 10. Okay, guys, am I making it a little too, is this complex for you all to understand? Do you all need a 5-10 minute break? Break. Okay, majority of the people said no, so I'm gonna continue, right? So please tell me if you need a break. Just let me know. If you feel like, dude, whatever I'm saying, you're not able to understand, then I'll give you a break. Okay, it's interesting. Okay, awesome. Now, now I'm gonna make a few changes to whatever we've learned so far. Okay, from this moment onwards, you are no longer going to call support levels and resistance levels. From this moment onwards, resistance level, you are going to be calling it as equal highs. Okay. So whenever I'm typing in EQH, understand that it means a resistance level. Now, why is it called equal highs? Because see, all these highs that is creating, it's equal, right? That is the reason why I'm calling it a equal high. Is that clear? Is that clear? Do you all understand what an equal high is? Now, if resistance levels are equal highs, then what is equal lows? What are equal lows? Support levels, right? Perfect, perfect. Which means this right here, that right there is your equal low. These are equal lows, EQL. All right. Now, again, guys, what is the general assumption that we'll be making? General assumption is that whenever market breaks an equal high, it absorbs the liquidity and comes back down. Again, once we have an equal low, what is the general assumption that we'll be making moving forward? That market will absorb the liquidity and reverse. Clear? This is the general assumption that we'll be making. Now, obviously, it is not just equal highs where we can find pools of liquidity, right? For example, I'm going to mark this once more. So that right there is my equal highs. This right here is my equal lows. Equal lows. Now, is it fair for me to make this also as an assumption? So this right here is my trend line. Is this right here a fair assumption for me to make? Can I make that assumption? Yes. Perfect. Perfect. Right? So please take a mental screenshot of this. This is going to be your general assumption moving forward. So again, the whole reason I've explained this entire thing is because from this moment onwards, I do not want you all to trade breakouts. You should never be trading breakouts. It's a very illogical thing to do, right? Now, if all of this is understood, wait, what is the time? 8:30. Okay. So I have 1 more hour, right? Okay. Guys, is it okay if I fasten the pace a little bit? Is it okay? Is it okay if I fasten the pace a little bit? Because there is so much more to cover and we only have 1 more hour. Yes? Is that okay? Okay. All right. Perfect. Hey, thank you guys. Thank you. All right. Now, okay. Perfect. Awesome. Now, now that you understand what is breakouts, what is liquidity engineering, what is price inducement, how breakouts fail, the reason why price action trading doesn't work, I hope all of that is clear. I hope all of that is clear, right? Now, I'm going to introduce you all to something called imbalance. Now, guys, in the market, institutions, we already understand that institutions use high frequency trading algorithm, right? Now, so I'm going to explain how this works. So if I'm LIC and I want to trade for this much money, what I'm going to do is I'm going to deploy this money into this algorithm and I'll be like, bro, algo, listen, I want to trade for this much money. Please do the trading, right? So this algorithm is responsible for delivering the price. It is called price delivery. Okay. So this algorithm is responsible for moving the market up and down. How the price, how these candles are formed, if it's big candles, small candles, how the price is delivered in the market, it is decided by the algorithm, right? Now, once the algorithm understands what it's supposed to be doing, there are two ways in which the price is delivered in the market. Okay, there are two ways in which the price is delivered in the market. One is efficient or balanced price delivery. Second is inefficient or imbalance in price delivery. Okay, so there are two ways in which price is delivered in the market. One is efficient or balanced price delivery. Second is inefficient or imbalance in price delivery. Now, I'm going to plot the difference between both. Type yes if you, I'm going to keep plotting it until you understand. Okay, if I tell you that this right here is balanced price delivery and this right here is imbalance in price delivery, are you able to understand the difference? If I tell you that this right here is balanced price delivery, and if I tell you that this right here is imbalance in price delivery, are you able to understand the difference? If I tell you that this right here is balanced price delivery, and this right here is imbalance, this right here is imbalance in price delivery, and this also right here is imbalance in price delivery, are you able to understand the difference? If I tell you this, if this right here is balanced price delivery, imbalanced price delivery, I'm going to keep doing this. Balanced, balanced price delivery, imbalance in price delivery, balanced price delivery, balanced price delivery, imbalance in price delivery. Understood? Are you able to understand the difference? Balanced price delivery, imbalance in price delivery. Okay? Perfect. So your imbalance obviously means huge candles. You'll see huge candles in your imbalance price deliveries, right? Now, guys, can I consider this as an imbalance candle? Can I consider that as an imbalance candle? Imbalance candle? Yes. Perfect. Now we are going to micro analyze what's happening here. Okay. Let's try to understand how this balance and imbalance price deliveries work. So I'm gonna plot an imbalance candle right here. That right there is my imbalance candle. And this candle goes from 100 and quickly jumps all the way to 120. This is my scenario number one. I'm going to give you two scenarios. Okay, this is scenario number one where we have an imbalance candle. This is imbalance or inefficient price delivery. In scenario number two, we have a balanced or efficient price delivery, which will look like this, right? You'll be having tiny candles. You'll be having a bunch of wicks. All the candles will be overlapping each other, right? This right here is your balanced price delivery or efficient price delivery. So you'll be having a bunch of wicks, wick here, wick here, wick here, wick here, wick here, wick here. Now here also the price is starting, the price starts at 100 and goes all the way till 120. Now this is scenario number two. Now guys, in which scenario would you say that the price between 100 and 120 was traded properly? Scenario one or scenario number two? Type. In which scenario would you say that the price between 100 and 120 was traded properly? Now, everyone says scenario 2, but why do you say that, guys? Why do you say that the price was traded properly in scenario 2 and not in scenario number 1? Why do you say that? Think about it. Logically, why do you say that? It took time, overlapping candles. Okay, but what does that mean? To reach that price, there was liquidity. What else? Multiple candles. Orders are met. No drastic shift. All right. So let's try to understand what's happening in scenario number 1. Okay, so let's focus only on scenario number 1. Oops, did I? 1 second. Okay. Now we'll focus only on scenario number 1. I have a huge imbalance candle. Okay, from 100 and it goes till 120. Now let's assume let's assume the price was at 100. Now when the price was at 100, again I'm LIC and I am placing an order for 100,000 shares. I am placing a buy order for 100,000 shares when the price was sitting at 100. So how does the candle functions, guys? So at 100, if I put this order for 100,000, let's assume the algorithm is like, okay, place an order for 100,000, right? And the price is at 100. So how the candle functions is the candle will keep going up until it finds 100,000 sellers, correct? Because for this order to go through, I need 100,000 sellers, right? So the candle, the price starts at 100. 100 is where this order came in, this 100,000 order came in. The candle will keep going up until it finds 100,000 sellers, right? So it will search for sellers, no sellers here, no 100,000 sellers here, no 100,000 sellers here. And finally, it stops at 120. What does that mean? The fact that the candle stopped at 120 and not anywhere in between, what does that mean? It means, exactly right. It means market was able to find 100,000 sellers only at 120 and not in between. Market was only able to find 100,000 sellers at 120. Correct? Because let's assume, let's think about it, right? So if at all we had 100,000 sellers sitting at 105, where should the candle close? Should the candle close at 120 or should the candle close at 105? Is it close at 105? Correct. But the fact that the candle only closed at 120 means that there was no liquidity in between 100 and 120 to fulfill my order. So what happened? The candle keeps heading higher until 120 and my order gets filled. Now, if you think of what is happening inside this candle right here, would you say that, see, because technically I would have preferred to buy 1 lakh here, 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 1 lakh here. I would prefer to buy at all the price points. Was I able to do that? Was I able to buy 1 lakh at all the price points? No, right? I was only able to buy 1 lakh at 120, right? So that automatically means that inside 100 and 120, I was not able to efficiently trade. And that is exactly the reason why this right here is called a market inefficiency. This is inefficient price delivery. Okay. Why is it called inefficient price delivery? Because I was not able to efficiently place orders, efficiently trade between 100 and 120. I was only able to trade at 120 due to the lack of liquidity. Now, technically, would you agree if I say that between 100 and 120, this entire area right here, in between this entire area right here, there is no liquidity? Would you agree? Perfect. Perfect. Right? Now, let's look at scenario number 2. In scenario number 2, again, I'm doing the exact same thing. I'm LIC. What am I doing? I'm placing an order for 100,000 shares at 100. In scenario number 2, what happens? The candle opens at 100 and closes here. What does that mean? What does that mean? The fact that the candle closed here, what does that mean? That means that I was able to buy 1 lakh sellers here. Let's assume this is 105, right? So when the next candle opens, I'll again punch in another order for 1 lakh, and that candle also closes here, correct? So I was able to buy in this second scenario, I was able to buy 1 lakh here, 1 lakh here, 1 lakh here, 1 lakh here, 1 lakh here. Would you agree if I say that in scenario number 2, I was able to buy a total of 1, 2, 3, 4, 5, 5 lakh worth of shares? 5 lakh shares I was able to buy by the time it reached 120. Would you agree? Now, doesn't that mean I was able to efficiently trade from between 100 and 120? Sorry, I was efficiently able to trade between 100 and 120, correct? But in scenario number 2, was I able to efficiently trade? Exactly, right? So whenever there is an imbalance candle, institutions are not able to efficiently trade. Now, whenever there is a balanced price movement, please understand that efficient trading has happened. Now, again, coming back, if you look at the charts, I know that it's India VIX, doesn't matter. Did efficient trading happen here? Did efficient trading happen here? Perfect. Was the market able to efficiently trade here? No, it didn't. Perfect. Awesome. Right? Now we move on to rule number 2 of price behavior. What is rule number 1 of price behavior? Market always moves in search of liquidity. Now I'm going to introduce you all to the rule number 2 of price behavior. Market always tends to fill the imbalance. Again, this also is going to be your bread and butter moving forward. Please take a screenshot, type done once you're done taking the screenshot. The second rule of price behavior states that the market always tends to fill the imbalance. Done. Quickly, guys. Perfect. Now, as per this rule, the second rule of price behavior, what does it say? It says that market always tends to fill the imbalance. What is imbalance? This area right here. This area right here, that right there is your imbalance, right? Now, what does the rule says? The rule says that whenever there is an imbalance, market tends to come back and fill this imbalance. This is what the rule says. Now, the idea is very simple. I'm going to give you two scenarios. In scenario number one, price goes from 100 all the way to 120. So I'm able to buy at 120, buy 1 lakh at buy 120. And then the price goes to 200 and I sell everything at 200. This is scenario number one. So what is happening in scenario number one? I tried to enter at 100. I was not able to buy at 100 because my order got placed at 120. And I was able to buy 1 lakh here, 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 1 lakh here. And I sell everything at 200. This is scenario number one. Now in scenario number two, price comes back down, fills the imbalance, and then goes to 200, which means initially I was able to buy 1 lakh here. Then I was able to buy 1 lakh here, 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 and sell everything for 200. This is scenario number two. In which scenario was I able to make more money? In scenario number one or scenario number two? Obviously, it's scenario number two. Why was I able to make more money in scenario number two? Because the area which I was not able to trade previously due to this imbalance, that area, when the market comes back down, I was able to trade. So when the market comes back down to fill the imbalance, I'll trade 118, I'll put 1 lakh orders, 115, I'll put 1 lakh orders. All these price points, I'll start buying. Is that clear? Type yes if you understand this logic. The reason why market would want to come back and fill the imbalances. Awesome. Clear? Perfect. Perfect. Right? So what again? Again, what is our expectation? Whenever market creates an imbalance, market always tends to come back and fill the imbalance. This is our general assumption that we'll be making. Now, see, technically, it's not necessary that after market fills the imbalance, it has to come back up. Not at all. That was just an example, right? Market can fill the imbalance and continue heading lower as well, right? The point being, the institutions hates it when inefficient trading has happened. Institutions want to efficiently trade all the price points. Please keep that in mind. Institutions wants to efficiently trade all the price points. So whenever there is an inefficient price delivery happening, market will try to come back and fill that imbalance so that market can efficiently trade the price points it was not able to trade previously. This is the theory behind it. Now, can I show this to you all in chart? If the theory is understood, can I show this to you all in chart? Yes. All right. Oh, I'm watching 15 minutes. 1 second. Guys, can I consider this as an imbalance candle? Is that an imbalance? Is that an imbalance? Right? Now, guys, when I'm plotting imbalance, I'm not considering the wick. Why do I not consider the wick? I'll be very impressed if someone can tell me the answer. Why do I not consider the wick? Why do I only consider the body when I'm plotting imbalance? Why do I not consider exactly? Exactly. The wick means this area is already traded. This area is also already traded, right? So efficient delivery, efficient price, efficient trading has already happened here. So the body is the area where efficient trading did not happen. So whenever we look for imbalances, we only look at the body. Okay. Now let's look at the next candle. What happened? Did the imbalance get filled till here? Imbalance got filled till here, right? Let's look at the next candle. What happened? Imbalance got filled till here. Let's look at the next candle. The entire imbalance gets filled, right? So we'll keep doing this. We'll look at all the imbalance candles being created and we'll try to see how it's getting filled. Is that an imbalance candle? Is that an imbalance candle? Big candle, right? Let's look at the next candle. What happened? The entire imbalance gets filled. Is that another imbalance candle? What happened to the next candle? The entire imbalance gets filled. Little bit of imbalance remains here and here. Entire imbalance gets filled here. But now if you see here, is that another new set of imbalance that happened? This imbalance got filled. Is that a new set of imbalance? Is that a new set of imbalance? Let's look at the next candle. What happened? The imbalance got filled till here, but now we have another set of imbalance right here. Let's look at the next candle. What happened? This entire imbalance gets filled. But this also is a imbalance, right? That also is a huge candle. So I'm going to plot the new imbalance. Let's look at the next candle. What happened? This entire imbalance gets filled. This imbalance gets filled till here. Let's look at the next candle. Imbalance gets filled till here. Let's look at the next candle, next candle, next candle. This entire imbalance gets filled. Let's continue. This entire imbalance gets filled. That also is a new set of imbalance. Entire imbalance get filled, but this imbalance is being filled by another imbalance candle, which means liquidity is still not there in between this area. So I'm going to consider that as my imbalance. Imbalance gets filled till here. Imbalance gets filled till here. Again, I have another imbalance candle here. Let's look at the next candle. Imbalance gets filled till here. I'm going to extend this imbalance here. I have another imbalance candle here. I'm going to extend that as well. Let's look at the next candle. Imbalance gets filled till here. This entire imbalance gets filled. Now we have new set of imbalance. That's again another imbalance candle which got filled till here. Let's continue. Imbalance gets filled till here. Oops. Imbalance gets filled till here. I'm going to extend these imbalances which are left unfilled. Imbalance gets filled till here. Entire imbalance is filled. Imbalance filled. Type yes if you understand this concept. Yes. Now, see, this doesn't necessarily mean that next time you see an imbalance, just because you see an imbalance, for example, they see that right there is an imbalance candle. Just because you see that imbalance, does that mean that you are going to sell here saying that, hey, Ritvik told all the imbalance will have to get filled. So market has to come back down to fill. So I'm going to sell here. Is that what I meant? Have I told you where to trade here? Not at all. Not at all. Everything will start making sense as we move forward. Don't worry, right? But this is extremely critical for you to understand. See, for example, we still have this imbalance remaining here. We'll see if that ever gets filled. I'm going to extend this imbalance. I'm going to extend this imbalance. See when it is getting filled. So you can't, just because you have an imbalance here, are you going to sell here and then hold all the way till here expecting the market to come back and fill? This is no, very stupid, right? That is very stupid, right? So this is not how you trade, right? But then it is very important for you to understand that whenever there are imbalances being created in the market, see, this is an area where liquidity was not there. So see what the market does. Market comes back down and liquidates that area. where there was no liquidity, market comes back down, provides liquidity, efficiently trades that region, and then does something else, right? I hope this is clear. So type yes if you understand exactly how efficient and inefficient price delivery works in the market. Is it clear? Proper? All good? Crystal clear? Now, if you all want, you all go take some 5-minute break because we're going to move forward to a different concept. So I don't want information overload. You all do get something to drink, whatever. Okay. So the time right now is 8:50. Please be back by 9. Or do you all want 5 minutes or 10 minutes? Dude, I don't think you'll need 10 minutes break. 5-minute break works. 5 is fine. Perfect. So I'll see you all at 8:55. Okay. We are going to now, after you come back, I'm gonna teach you how to trade. Till now, I haven't taught you how to trade. So once you get back, I'm gonna tell you how to trade. Okay. So be back by 8:55. How much is my win? Okay, so my winning streak is currently 1 month and 2 weeks. Man, I see. Honestly, I'm just getting lucky. Honestly, right? But then this is my longest lasting win streak. I haven't had a single losing trade for more than 1 month and 2 weeks. Not a single losing day. But yeah, man, I'm just getting lucky, I suppose. Highest profit in this one month 2 weeks. It happened some 3 days back, right? I think you're not following my page, is it? It was, I think, around 4.1 lakhs. It happened that the day after that election on June 5th. 4 lakhs, 4.1 lakhs in this one and a half month. Right? Okay. No, sorry. You'll go back, come back in by 8:55. Insta page, it's at RITVIIIK. If you want to go follow, please give me a follow. Plus, guys, plus a quick disclaimer: once you start following me, there will be people with my same name, my same number of followers, and they'll start DMing you saying that, hey, if you give me 50,000, I'm gonna give you this much percentage profit. If you give me 2 lakhs, I'm gonna give you this much percentage profit. Guys, I'm never going to DM you first. So if you get a DM from someone with my see, I have some 1,12,000 followers. So if you find these people will also have my same number of followers. I have no clue how they buy these followers, but then if you find someone DMing you asking you for money, and if he has my same name, looks like my same profile, please understand that it's a scam, right? Because one person lost 7.5 lakhs because he thought he was giving this money to me, right? So please understand that it's not me. Please don't give your money to someone. I'm never gonna take your money. Cool. All right, let me just fill my water bottle and come back. Okay, guys, 1 second. I'm audible. I'm audible. Is everyone here? Guys, type yeses. I need 480 yeses. 480 yeses and I'll continue. Guys, type. We have so much more to cover and only 30 more minutes. Okay. All right. Okay. Again, before we move on, don't worry. I'll extend. Don't worry. 1 second, guys. Guys, is it fine? Do y'all? Is it fine if we move? Is it if we wait? If we go till 10, maybe? Is that okay for y'all? No, I have to sleep. Okay. Okay. 1 second, guys. Let me just put my Mac on charge. 1 second. Okay. You can go till tomorrow. We'll be here. Okay. All right. Now, see, before we move forward, just making sure, if you understand exactly the reason why fake breakouts are created, if you understand what is liquidity, if you understand exactly what liquidity engineering is, if you understand how price deliveries work, if you understand what the difference between efficient and inefficient price deliveries, if you understand the reason why imbalances are getting filled, if you understand exactly the first two rules of price behavior, market always moves in search of liquidity, market always tends to fill the imbalance. If you understand these rules, please type yes, and we shall move forward. Perfect. Awesome. Now, before we get to the trading part, guys, can I just give you all a few reference materials just because I hardly have time to teach all. Obviously, we are just scratching the surface of stock trading, right? Just the surface of stock trading. So can I just tell you all what all you should be learning by yourself before we move forward? Because that I think is extremely important, right? Because there are a lot of things that you need to understand. See, for example, see, market always moves in basis of accumulation and distribution structures. Market always moves in basis of accumulation, reaccumulation, distribution, and redistribution structures, right? So you have your, let me change the color. You have your accumulation. See, I'm just explaining all this because you've told me that I can extend the time, okay? Please don't get mad at me for uh, for quitting this, for making this session go longer. Now, see, market always moves in basis, right? So you have your accumulation. So this is called your accumulation base, reaccumulation base, distribution base, redistribution base. Okay. Now, so there will be an accumulation base and then the move up, reaccumulation, move up, right? These move ups are called markups. Markup, that's your markup. And this right here, this move down is called your mark down. All right. Now, and so these entire distribution structures, if you can predict exactly how this structure moves if you understand something called the Wyckoff schematic, right? Guys, how many of y'all have heard of Wyckoff schematic? Wyckoff schematics? No one? Your upthrust, your springs. If you watch my reels, okay, see, um, 1 second. I'll quickly show you Wyckoff schematics, okay? So this, if you see right here, Can you see selling climax, preliminary support, automatic rally, secondary test, spring, and the sign of strength? So every time market breaks out of a base, right? Regardless of what the time frame is, every time market breaks out of a base, right? Before an actual move up happens, it will form in terms of a Wyckoff schematic, in terms of a Wyckoff accumulation, right? So this is exactly how your accumulation structure will look like. You'll have your selling climax, which shows that your selling has stopped, right? And then you have a preliminary support, automatic rally, secondary test. Spring is like your fake breakout, right? Usually, whenever market tries to go somewhere, it will create a fake breakout. It will make sure all these people are trapped before the move up happens. Again, a fake breakout, move up. Fake breakout, move down. Fake breakout, move down, right? So market will always attempt to trap a last tiny bit of people, last manipulation before the market heads into its proper direction, right? So that is what is a spring. Now, just like how you have your Wyckoff accumulation structures, you have your Wyckoff distribution structure as well, right? Which will look like that, right? So you will have a buying climax, preliminary resistance, automatic sell-off after secondary test, and a sign of weakness. So you'll be ideally entering a sign of weakness for a move down and a sign of strength for a move up, right? So similarly, so just keep in mind that market always moves in basis, right? For example, if I look at the Nifty chart, if I go to 1 day time frame, do you know the reason why the market stopped here during that election rally? Do you understand the reason why? Do you have any clue why the market stopped here? Because no news is bigger than your weekly accumulation structures. No news is bigger than your weekly accumulation structures. Doesn't matter what the news is, it is the amount of money which is built here to create this entire up move is so much. The lakhs of crores are being accumulated here, right? So it is impossible, no matter what the news is, it is impossible for the market to break these structures, right? So please understand that market always moves in basis, right? So uh you'll have your accumulation base here, sorry, distribution base here, accumulation base here, another base, 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 right? So market always moves in terms of basis, right? Every time market always moves in terms of basis, right? And understanding, reading this is extremely important. So again, like I said, similarly, I'm going to give you a few reference, not materials. I'm going to give you a few concepts that I need you all to learn by yourself, right? Wait, once, how many of you are already part of masterclass? Type yes if you're already part of masterclass for the coming weekend. 2, 3, 6, 7, 8. Okay, see there 8. See, none of you all had to necessarily. You didn't have to attend this bootcamp because I'm gonna be you're gonna be learning all this either ways. But if you're trying to learn this by yourself, which is definitely possible, right? I'm gonna give you the few things that you should be learning. One is VCP, which is called volatility contraction pattern. This is something that you'll be using if you want to trade swings, right? Now, for you to understand VCPs, it is important for you to understand faulty basis as well, right? Now, then we have your VSA, which is volume spread analysis, understanding how volume spread works, and then you'll need to understand about supply and where is that, and demand buildups. Then your order blocks I'm going to teach you, right? So don't worry. Then you have your mitigations and breakers. And then you need okay, volume and gap imbalances, your inversions, and obviously your fair value gaps, and a little something called premium equilibrium discounts, and let me think. 1 second, guys. Okay. Liquidity sweeps. Understand in depth about liquidity sweeps and how it functions, and then you have your Wyckoff schematics. Right? Please take a screenshot of all this and type done once you're done taking the screenshot. Am I missing something, guys? 1 second. What is this there? Okay, this is enough. Right? Please take a screenshot. Then now, guys, if y'all are very super passionate about stock trading, and if you're trying to go full time, please understand that without learning all this, it's please don't enter the market. Right? It is going to be very hard for you. Right? Again, stock market it's a very difficult skill to master, and you need in-depth understanding of everything that happens in the market. Right? Breakout structure, change of character, that I'll teach you. Right now I'll teach you breakout structures and change of characters. Don't worry. Right? I hope that's done. Right now, please, I want you all to read these two books. Trade like stock market wizard by Mark Minervini. This is book number 1. Trading in the Zone by Mark Douglas. Please read these two books, okay, before you enter the market. All right. Can I move forward? Is it done? Screenshot done? All right. Perfect. Now let's get back into business. Okay. Now, 1 second, guys. Let me just close. Oh, no wonder I'm in 1 day frame. Okay. Now I'm gonna introduce y'all to something called demand and supply zones. Okay. Demand and supply zones. Now, the idea is very simple. What are demand and supply zones? Now, see, would you agree if I say that, let's assume this is how the market is doing, it does a sweep of liquidity here, that's a manipulation, and let's assume then we have a move up, big imbalance move up like that. Big imbalance move up, right? Would you agree if I say that right here at the base, a lot of strong institutional buying would have happened? Would you agree? A lot of institutional buying has happened here. Would you agree? Huge amount of institutional buying has happened here, right? Because obviously, right, for there to be an imbalance, for there to be an inefficiency created in the market, the amount of orders should be so high that the liquidity should not be enough, right? Isn't that the reason why imbalance candles are created in the first place? So obviously, it should be very obvious that at the base, a lot of institutional buying has happened, right? So your demand zone is nothing but the base of the movement. This base right here is called your demand zone or your order block. Okay. Now, the idea is very simple. Since there is a lot of institutional orders being placed here, what we are expecting the market to do is we are expecting the market to come back down. Now, guys, let me ask you this question. Why does the market have to come back down? Why does the market have to come back down? I'll be very exact. Good job, guys. To fill the imbalance. To fill the imbalance, right? So when market comes back down to fill the imbalance, it will come back and tap into this demand zone. And guys, what is sitting at the demand zone? Institutional activity, strong institutional activity. A lot of orders are being placed here. So those orders will again get executed, and then price continues heading higher. Do you all understand the logic of why we are looking at demand zones? Very easy concept, right? Similarly, just like how you have your demand zones, you have supply zones. What are supply zones? Same thing. Let's say you have huge move to the downside. I'm going to change the color to red. Is it fair for me to assume that a lot of institutional selling has happened here? Right? So that right there is my supply zone. So when the market comes back to fill the imbalance, it taps into the supply zone. Institutional sell orders are sitting here, strong institutional sell orders. What happens? The remaining orders get executed, boom, goes back down. Clear? Can I show this to you all in chart? Is this understood? All right, perfect. Perfect. Now, guys, can I consider this as a supply zone? Is it fair for me to assume that there is a lot of selling that happened here which pushed the market down like that? That's a supply zone. So what do? I extend my supply zone. What happens? Market taps into my supply zone and continues heading lower. Is that clear? Understood this? Can I move on? Can I show you more examples? Now, is it fair for me to assume that right here, this right here is a demand zone? Is that a fair assumption to make? That's a demand zone. Market created a huge move up, a lot of imbalance candles. Demand zone. So I'm going to extend my demand zone. What happens? Every time market taps into my demand zone, what happens? It heads higher. Clear? So that is my demand zone. Even if you don't extend till there, let's assume we are only extending till here. What happens? Market comes back down, taps into a demand zone, heads higher. Taps into the supply zone, heads lower. Clear? Do you all have a general understanding of how the market functions in terms of demand and supply zones? Do you all want more examples, or do I continue? Okay, I'll give you easier ones. Can I consider this as a supply zone? Can I consider this as a supply zone? So I extend it. What happens? Market taps into my supply zone, goes down. Clear? Understood? Understood the difference between demand and supply zones? Now, obviously, if you think about this, ideally, what are we trying to do? We are going to attempt to sell at a supply zone, right? Right? That is supply zone. Market comes, taps into the supply zone, again comes back down, right? So we have to figure out some sort of entries here at the. So we have to sell at the supply zone. We have to buy at the demand zone. That is very clear, right? But obviously, we can't obviously sell or buy at all the demand zone, right? So you will see market reacting to our zones, But then you can't necessarily buy at all the demand zones and all the supply zones, right? See, okay, let me ask you this question. Do you all understand what's happening here? Do you all understand how the market is moving from here to here to here to here to here? Do you all want me to break it down? See what's happening here? Market created a demand zone, a lot of imbalances, right? Which means this right here is a demand zone. So I plot this demand zone, and from here, market again aggressively dumps, which means this right here is a supply zone, right? So I'm going to mark that supply zone as well. So what is happening? Market is coming back down, tapping into my demand zone, heading higher, tapping into my supply zone, heading lower, again tapping into my demand zone. Clear? Guys, type yes if you understand this. Type yes if you understand how the market is moving here. Perfect. Okay. All right. All right. Now, before I teach you all how to trade, I'll tell you how to enter. Okay, I'll tell you how to plot your correct demand and supply zones. Don't worry. Before I teach you all how to enter, how to trade, I'm going to introduce you all to something called break of structures and change of characters. Break of structure, change of character. Okay. Now, guys, everyone knows market structures, right? If it's an uptrend, if it's in an uptrend, what is the market creating? Market is creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? Now, if it's in a downtrending structure, market is creating what? It's creating lower lows, lower highs, lower lows, lower highs, right? Now, I'm going to plot an uptrending structure. Let's assume this right here is an uptrending structure. Now, for this to become a downtrending structure, which level should the market break? Should it break level number 1 or level number 2? For, for this to change from an up to exactly level number 1, right? So the moment market breaks this level right here, now it's no longer an uptrending structure. Now it's a downtrending structure, right? Now, for this downtrending structure to again become an uptrending structure, which level should the market break? Level 1 or level 2? Exactly, the level 1, right? So the moment market breaks that, the structure becomes what? It becomes an uptrending structure. Correct? Now, the level which the market has to break to change the structure of the market, to change the trend of the market, is called your change of character. That right there is your change of character. This right here again is your change of character. Is that understood? Now, if that is a change of character, what is the breakout structure? To put it in very simple terms, breakout structure shows continuation of the trend. For example, this right here, that is the breakout structure. This right here, it's continuing this uptrend. That is a breakout structure. Now, after change of character, after this change of character, guys, what is the trend of the market? It's downtrending, which means this structure break, is that a breakout structure or is that a change of character? This break right here, is that a breakout structure or is that a change of character? Exactly, it's a breakout structure. Why? Because it's continuing the downtrend, right? Again, we have another, what is that? That right there is another breakout structure, right? So after change of character, we have a continuation, which means this right here is also a breakout structure. Guys, type yes if you understand the difference between change of characters and breakout structures. Now I'm going to make you all do an assignment with me right now. Okay. All right. What is that? What is that? That's a breakout structure. Correct. What is this? Nice. That is a change of character. What is that? What is this? Correct. That is a breakout structure. What is that? Exactly. That's a change of character. Now, what is this? What is that? Correct. That's a change of character. That is not a breakout structure. After the change of character, it's an uptrending structure. It immediately came back down and broke another structure to the downside, which means that's a change of character. That's not a continuation. Got it? That is a change of character. What is that? Exactly. That's a breakout structure. That's a breakout structure. That's a change of character. Breakout structure. Clear? I hope this is clear. I hope this is clear. Can I move on? Can I move forward? All right. Now I'm going to plot a few things. Please give me some time to finish this. Until after that, I'll explain, okay? POI means point of interest, okay? That is your breakout structure. That is your change of character. Guys, I want you to take a screenshot, type done once you're done taking the screenshot. OB is order block. Take a screenshot, type done once you're done taking the screenshot. Done? All right. Now I'm going to explain. POI means point of interest. OB is order block. It's basically the same thing, right? Now, guys, why do you think I have plotted this supply zone in the first place? Because obviously in the left somewhere, market would have created something like this. Correct? Market would have created something like this. That is the reason I have considered that as my supply zone, right? So imagine we have a supply zone. That right there is a supply zone. Now we have to sell at the supply zone because why? Because every time market taps into the supply zone, we are expecting market to come back down, right? But guys, the problem here is we cannot always sell as soon as it taps into the supply zone. Why not? I'll be very impressed if someone can give me the answer. We cannot sell exactly the moment it taps into our supply zone. Why not? High liquidity, no liquidity, no, nope. What else? Think about it. You already understand the answer. You already know it. Wait for confirmation. But what is your confirmation? Why are you waiting for confirmation? No volume. There's buy orders. Exactly. Good job. What's your name? Hey, good job. See, after breakout structure, What is the trend of the market? After the breakout structure, what is the trend of the market? What is the current trend of the market? It's in an uptrending structure. The general thumb rule of stock market is you never sell when the market is in an uptrend, right? Because that is very illogical, right? When the market is in an uptrend, why are we looking to sell, right? So for us to have a shift in the trend of the market, what do we need? We need a change of character. So the moment market creates a change of character, now we know for a fact that, okay, now this supply is strong because this supply created a change of character. So now we know that, okay, this supply is strong enough to create a change of character. So now market might be trying to head lower. Okay. The second thing you need is your OB 2.0 or your supply zone 2.0. So your OB 2.0 is nothing but a smaller supply zone which is responsible for creating the change of character. See, for the time being, let's remove flip and flip zones and just concentrate only on this. Okay. Now, your OB 2.0 is nothing but a smaller time frame supply zone which is responsible for creating the change of character. All right, which means this is our main supply zone. This is our main supply zone. But during its move down to create a change of character, market will be creating another supply zone, which means there will be another supply zone with imbalance candles. So you mark that supply zone and you wait for the market to come back and tap into your supply zone. And here you are going to sell. This is where you will enter. You will sell here and then you will wait for the market to go back down and take this structure. This is going to be your target. Type yes if you understand the theory. After this, I'll show this to you all in chart. Don't worry. Type yes if you understand this. I'll explain. What part of this do you not understand? I see a few no's. Which part of it did you not understand? OB 2.0? Okay. Okay. So the idea is, see, you all know how we have a supply. See, where did I plot it? In Nifty spot. So I can remove this, right? For example, see, in the 2-minute time frame, can I consider that, sorry, can I consider this as my demand zone? Can I consider this as my demand zone? Yes. So this is your smaller time frame demand zone, correct? This is a very tiny demand zone, right? Only 1, 2, 3 imbalance candles are here, right? Similarly, after market taps into your OB supply zone, there will be a tiny supply zone which creates a change of character. For example, let's assume this move up is breaking some structure here, which means this right here is a change of character, right? If that right there is a change of character, similarly, here, after market taps into the main supply zone, our big supply zone, market will create another tiny supply zone, which will be responsible for creating this change of character. Okay. So that supply zone you will extend. And this tiny supply zone, this new tiny smaller supply zone is where you will expect the market to come back and tap so that you can enter here. You will short here, you will sell here, and then you will target the low which was created here. Don't worry, everything will start making sense once I show this to you all in chart. Clear now? Is it clear? Are you able to understand this theory part? Can I show this to all in chart? Okay, do you all want me to show this to all in a higher time frame so that you understand the fractal nature of the market? Do you all want me to show this to all in a daily time frame? Cool. Done. I'll show this to all in a daily time frame. Now tell me the name of a stock. Tata Motors. Okay, done. We'll do Tata Motors. Because I think I already know. Okay. Um, um, can I consider this as a supply zone? Can I consider that as a supply zone? Yes, that's a supply zone, right? This is 1 day time frame. This is 1 day time frame. Okay. Now, why do I consider this as a supply zone? Because do you see these huge imbalance candles that are created here? That is the reason why it is. I've considered this as a supply zone, and obviously we have a sweep here. We have a higher time frame sweep, right? Which is a very, it's a little complicated concept, but let's not get into that. Now that right there is my supply zone. So ideally, what am I expecting the market to do? I am expecting the market to come back and tap here and then move down, right? Now here is where I have to tell you all a little something about risk to reward ratio. Now we are going to get into how you are going to be trading. Okay. Now you will always trade only based on risk to reward ratios, which means, sorry, excuse me. So you will only trade if at all your trade is giving you a minimum of 1:2 risk to reward ratio, which means if I'm risking 1,000 rupees for my trade, my minimum target should be how much? My minimum target should be exactly, it should be 2,000, right? And the general thumb rule of stock trading is that you will never risk more than 2% of your capital per trade, which means if you are risking 2% of your capital, your minimum target should be how much? 4%. Correct? Now I'll tell you the why this is extremely important. For example, let's assume you take 10 trades. Out of 10 trades, let's say you only have a 40% win rate, which means out of the 10 trades that you took, 6 trades you lost money and 4 trades you made profit in 1:2. Not even 1:3, 4, 5, 6, 7, only 1:2. Okay. Now, which means it is 1:2, right? Which means every time you lose 1. Every time you 1 hour, every time you win, you make 2 hour, right? And understand how much is your risk. What is your 1 hour? Your 1 hour is 2%. You're only allowed to risk 2%, right? So 6 trades, if you lose, 6 multiplied by 1, 6 hour is what you lose, correct? 4 trades, if you win, 4 multiplied by 2, 8 hour is what you make, which means 8 minus 6, you win 8, you lose 6, which means you are left with 2 hour. 2 hour is how much percentage? 2 hour is how much percentage? Your 1 hour is how much percentage? Your 1 hour is 2%, which means 2 hour is 4%. Correct? That means even if you have a 40% win rate, even if you only have a 40% win rate, if majority of the trades that you enter is wrong, you will still remain in profit. Okay, please make sure you keep this in mind. Now guys, I'm sure you must have seen people making people claiming that they have doubled their money, triple their money, their entire investment was 1 lakh. In 1 day they made 2 lakhs. You know what these people are doing? These people per trade, they are risking 100% of their capital. 100%, because that means if one trade goes wrong, they lose this entire 1 lakh together. So please don't think that these people are good traders. No, these people are gamblers. They are treating stock market like a casino. That's not how you do it. You are only supposed to risk 2% of your capital per trade. I was one amongst them. You never do it, right? One trade, if bro, if one trade, if it goes wrong, if your whole trading career is going to end right there, you are being very stupid, right? So you will never trade, you will never risk more than 2% of your capital per trade. Now, coming back to Tata Motors, if you look here, my entry might be somewhere around 520, my exit might be somewhere around 540, which means my risk here is 20 rupees. If I am risking 20 rupees, guys, what should be my minimum target? Exactly, it should be 40, right? But the thing is, see, risking 20 rupees in a 520 rupees stock, it is a little too much, right? So we can refine it. So what I'm going to do is I'm going to go to the smaller time frame. Let's go to 30-minute time frame. Before that, can someone okay, can someone please put 17th November 2021 in the chat box so that I can just come back to the same date? 17th November 2021. Okay. So this right here was a one guy put 17 November 2028. Okay. So this right here was a daily supply that we plotted. Now, guys, let me ask you this question. Is that right there? Is that an imbalance? Is this area right here? Is that an imbalance? So can I expect the market to come back and fill this imbalance? Doesn't that mean I can change my supply zone from this all the way till here? Type yes if you understand this logic. Type yes if you understood the reason why I have refined my supply zone. Perfect. Why have I refined it? Because this entire area is an imbalance which is yet to be filled. Right? So till here, market can come back up. Right? So that is the reason I have refined my supply zone. Right? Because I'm expecting market to come back and fill this imbalance. Right? So market comes back up, taps into this, can and come back and tap into that imbalance. Right? Perfect. Now, if you look here, what is my new supply zone? What is my risk? 527, 537, which means my stop loss is 10 rupees. So my target should be 20 rupees as per our risk to reward. Now, I'm going to put it in bar replay. Hey. Oh, bar replay is not here for this date, is it? No, it's there. Okay, I thought it's not there. So this right here is my supply zone slash POI slash order block. Okay. Now, as per our chart, wait, where is the chart? Okay, chart I removed. As per our chart, we need the market to first tap into a supply zone and then look for change of characters and OB 2.0 and all that stuff, right? Now we'll wait for the market to, okay, this is the low which was created by the daily supply zone. I'll mark that low just in case. Now let me extend my supply zone. Oh, market created a new low. I'm going to mark that low as well because that could be a potential target, right? I'll tell you how that can be my target, but then I'll tell you where you will be keeping your target as well. Don't worry. I'm going to extend my supply zone. I'm going to extend my supply zone. Okay. Did market tap into my supply zone? Market tapped into my supply zone? Yes. Guys, what is this? What is that? That is breakout structure. Now, what is the next thing that I need? I need a change of character, right? So for there to be a change of character, market has to take this out. Correct? Market has to take that out for this to be a change of character. Now what we have to do is now we have to wait and see if market will take this out. Do I have a change of character? Do I have a change of character? Yes, I do. So I'm going to mark my change of character. Change of character. That is my change of character. Now, what was the next step? The next step was to find OB 2.0. Remember what I told was OB 2.0? OB 2.0 was the smaller supply zone which caused the change of character. Do we have a smaller supply zone like that here? Is there a smaller supply zone which caused the change of character? Yes, we do. This supply zone right here. Can I consider this as a supply zone? Can I consider that as a supply zone? So that right there is my OB 2.0. Okay. This right here is my OB 2.0. So this is where I'm going to enter. Can I sell here? Can I short here? Can I sell here? Can I enter the trade here? So this is going to be my entry. This is going to be my stop loss right above OB 2.0. That right there is going to be my stop loss. And my first target is going to be this right here. This right here is going to be my first target. This right here is going to be my first target. Clear? Till this part, is it clear for everyone? That is my entry, my stop loss, my target. Great. I'm selling here. I sold first. That is short selling, right? Now, so that is my entry. That is my stop loss. See, right now, how much am I risking? 522 is my entry. 527 is my stop loss. I'm only risking 5 rupees for this trade. Now it is solid. 5 rupees for a. So if I'm risking 5 rupees, which means I should make 10 rupees, right? But then what is my target? My target, if my entry is 520, if my entry is 520, my target is 504, right? 500 to 520. Around 20 rupees I'm targeting, which is almost 1:4. So we are good to go. We can take this trade. Right? Guys, I'm so sorry for fastening the pace because we have a little bit more to cover, right? So that is my entry here. And boom, your target is done. Right? This is going to be your first target. But the thing is, since this is a daily time frame supply, this supply tends to be extremely big, huge. So I'm going to keep that as my target. And we'll see what happens. This, I'm going to keep a boom, boom, that as my target. I'll keep that as my target. So this is a 1:17 hour trade. Okay. We'll see what happens. Okay, do you all think it's going to hit my stop loss or do you all think it's going to hit my target? Be very honest. Do you all think it's going to hit my stop loss or do you all think it's going to hit my target? No. So see, technically what's happening here is if you see right here, this is something called the gap imbalance. Right? So I'd assume this is just market coming to liquidate this gap imbalance. So this is going to be this should ideally start selling off from here. I'll extend this. See, the problem here is now we have another gap here, which market can come back and fill, right? See, that's filled. Now it should again start dumping. I'll extend this. And done. Type yes if you understood this trade. I hope at least a few of you all understood this. Clear? So what did we essentially do? As per the charting that I've done, so we have your supply zone here. This is the main supply zone. We have a breakout structure. So after market does a breakout structure, it taps into my supply zone and it gives us a change of character. So once you have a change of character, what do? We should mark our OB 2.0, right? That is our OB 2.0, right? So market comes back, taps into our OB 2.0. So once it taps into our OB, so what are we expecting? We are expecting the market to come back down, right? So we short sell. We short sell. We are going to sell, right? I hope you all understand that we can short sell in the market. We can sell. If we are expecting market to come back down, we can sell first and buy back later. Get it? So we are going to short sell here. We are going to sell here. And then this is going to be our main first target. So when when you all are trading, you are going to keep that as your target, right? But then see, for obviously, for Tata Motors, you can't hold, for equity, you can't hold overnight shorts. So for that reason, once you're trading overnight positions, you'll have to trade futures, not cash market. You'll have to trade futures. Okay, but FNO, don't touch FNO for the time being, right? But then, did you all understand the theory of what happened here? We have our supply zone, breakout structure, change of character, market taps into OB 2.0, taps, target. Clear? Now, do you all want an example in the lower time frame? Yes. Reverse trade, a bullish trade you want to look for? Okay, done. Let's look for some bullish trades in Nifty. Ayo, sorry, 1 second. One second, let's see. You need bullish trades, is it? See, I find a few entries, but then I think it'll just make you more confused, right? So I'm just trying to find easier ones so that it's easy for you to understand. Okay, see, I found one for shorts. Guys, can I consider that as a supply zone? Can I consider that as a supply zone? What is that? What is that? What is that? That is a breakout structure, right? That's a very tiny breakout structure. Now, if that right there is a breakout structure, what is that? What is that? That is a change of character, right? That is a change of character. Once we have change of character, what do? We mark the supply which is responsible for creating the change of character. Is this the supply which is responsible for creating the change of character? Is that the supply which is responsible for creating this change of character? Yes. So this right here is my OB 2.0. So what do? We wait for the market to come back and tap into our OB 2.0. And this right here is going to be our target. Type yes if you understand this trade. Now is it clear? Now is it clear? Just tell me, Amitansh. Right? It can be, see, it can be the entire supply zone. Doesn't matter. I just draw the half of it because That is where the market reacted. This entire area is a supply zone. Would you agree? So market tapped into the supply zone, breakout structure, created a change of character. Market came back, tapped into OB 2.0. Here you are going to enter. That is going to be a stop loss. This is going to be your target. Very simple. Very simple. Price has tapped 2 times into OB 2.0. Yes, it has. Doesn't make any difference. Doesn't make any difference. See, because if you enter here, if you short here, your stop loss is about 2.0. So no matter how many times it taps OB 2.0, doesn't matter. All you have to do is you have to wait for it to come back and tap into the into your target. Right? More examples. I'm trying to look for one to the upside. Because market has been dumping for all this while. It's kind of hard to find trades for the upside. We'll need to go back to when see, no. Do we have one here? Demand zone, breakout structure, change of character, OB 2.0. Type yes if you understand this trade. Breakout structure, change of character, OB 2.0, tap, stop loss, target. Clear? Clear? That's your demand zone, breakout structure, taps, change of character, demand zone, which is responsible for creating the change of character, comes back, taps into the demand zone, boom, goes up. Right, guys? If you all see, I know this might seem a little complicated because see, guys, usually order block is a system that we usually take maybe around 1 month to teach in our in our master class. So what I've tried to teach this to you all in 30 minutes. So please understand that it's pretty hard, right? It is complicated. I understand, right? But yeah, so please watch this video. I'm gonna send the recordings either ways. So please watch the video multiple times. All right, please backtest it. Cool. Now again, so again, not just order just by looking at order blocks is it's not enough, right? It's not enough. So please, whatever I've topics that I've told you know, please read. See, internet, there is nothing you can learn off of the internet. See, I understand that a lot of, I think some 8 of you are already part of masterclass. Don't worry, y'all I'm gonna be having sessions from next weekend onwards. Rest of y'all, please go to the internet, please. Whatever topics that you've screenshotted, please make sure you go through it. All right. Now, secondly, also is anyone part of PTT? Did anyone register for Pro Traders Test? I'm not sure. Did anyone register for the funding program? Okay, please don't, because see, Akash told me that some of you all have registered. If you registered, I would suggest you cancel your registration and take the money back. Don't register. Right? See, the problem is if you are registering for the funding program and if you do not know how to trade, you registering for the funding program is pointless because you're not going to pass the challenge. So why do you want to waste that 1K? Right? Don't be stupid like that. So if you've registered, please cancel the registration right now and take back the money. Right? We will refund you. Right? Before the program begins, if you wish to unregister, please text the concern whoever has reached out to you, someone from the team. Please talk to that person and re-register. I mean, get the refund, right? Because I am gonna assume the fact that you are part of this bootcamp means that you don't completely understand how the market functions. You don't necessarily know how to trade. If you're a person who doesn't know how to trade, there is no point in you trying to apply for the funding, right? Because you will fail. I know the rules are very straightforward. It feel because getting 2% in a month, it sounds very easy, right? But then if you don't know how to trade, it's not going to happen. Because if we are going to fund you, it is very important for us to understand that you take risk management properly, right? And if you're not a very well versed trader, you are not going to be uh, sticking to your um, risk management, right? So I would advise you against registering for the pro traders test. Okay, see the name in itself, it's a pro traders test, right? So unless you're a pro trader, don't apply for funding. I know this $20,000, $100,000 and all is very tempting, but don't. You are not going to, right? Horizon masterclass. See the whole reason. See, it's not even about the program, right? See, the whole reason we built this masterclass is so that dude, because when I started out some 8 9 years back, it was a very lonely scene, right? And I don't think there should be a trader out there who doesn't who sh- I don't think you should be sitting there lonely, not being able to understand how the market functions and the amount of emotional roller coaster that you'll be going through during while you're trading. It's so high that you'll need someone to talk to, right? So that is the reason I'm doing all this daily live trading. That's the reason we have these voice channels and all that stuff, right? It just makes the life of traders easier. But yeah, I mean, if you want to register, dude, end of the day, I don't want to come here sell you the program. So if you will find a form to fill, if you wanna know more about the masterclass, just fill the form. Someone from the team will get in contact with you. You ask whatever to that person, right? The form will be put in the WhatsApp group. Don't worry. Now, before I let you all go, please, I have something very important for me to tell you all. See, since you've watched me, you've listened to me rant for almost 3 hours. I'm gonna assume that y'all are very passionate about stock trading. If that is the case, please understand that it is very hard, right? Now, if at all you are coming into stock trading, please know that this is not a get rich quick scheme. You are not going to be making money anytime soon. You will need at the minimum, I'm telling, at the minimum, you will need to give it at least 6 months at the minimum, right? See, because end of the day, this is a very high income skill. Now, if it's a high income skill, please understand that it's going to be hard. Now, if you think that once you start trading within 1 month, you can start putting 1 lakh and making 1 lakh in profit, please, you're very wrong. I'm sure it's possible. I'm sure you might be making 1 lakh, you'll be putting 1 lakh capital and making 1 lakh profit. But please understand that this 1 lakh profit that you've made, you will eventually lose it because you're not trading here, you are gambling, right? So it is very important for you to understand that for the first 6 months, you are not going to be trading to make money. The first 6 months, you are going to be trading to learn how to trade. All right. So, and this depends. 6 months is just the minimum. For some people, it might take much longer than that. See, it's think of it this way. Let's say you learn how to play guitar from YouTube. Bro, if you learn how to play guitar from YouTube, you are not ready to perform in front of the crowd, right? You're not ready to to do a concert. For that, you need to have a lot of practice. You need to be exceptionally good at playing the guitar, right? Similarly, just like how you master any skill, I'm not talking about training, any skill, right? It comes with a learning curve. And please understand that such learning curve exists for stock trading as well, right? And please understand again, like I said, it's a very hard skill to master. I'm not saying it's impossible, right? See, if you are engineering students here, are there any mechanical engineering students here? Any struggling unemployed mechanical engineering students? See, if you can figure out why what is Newton's law of cooling, if you're able to understand that, this is not hard, right? It's much more easier. But the only problem, you know what the problem is? Understanding the system and stuff like that, it's not that hard. It's not that hard. But when it comes to you understanding how your brain functions, see, because I feel like if you're a trader, it is very important for you to understand a lot about neuroscience. You have to understand exactly how your brain functions. Now, for that, also, I can give you reference materials. You'll need to understand exactly how your brain reacts to XYZ scenarios in the market. Because, see, end of the day, guys, we are all hunters and gatherers, right? We all feel those raw human emotions of fear, hope, being hopeful, greedy, and all that stuff. And money is something which is extremely important for all of us. So, when money is involved, all these raw human emotions will definitely come, right? For example, if at all you're in a trade and you see yourself in profit for 10,000, you are not going to exit, because you will convince yourself that if I hold on more, I might make 20,000, right? And you, if after not exiting, if it comes back to 5,000 profit, you still won't exit. Why? Because you'll feel like, okay, no, the market has to come back to 10,000, then I'll exit. So all these things will happen. And especially when you're losing money, right? Let's assume you are down 10,000, you are losing 10,000, you're not going to exit. Why? Because you'll convince yourself, your brain will convince yourself that, okay, the loss will reduce, and now I'll exit when the loss comes back to 5,000. And eventually what happens? The loss will continue heading higher, it will go up, and before you know it, it will be 1 lakh loss, right? So this and all is a very tough thing to to master, unless you understand in depth about neuroscience. You have to understand how your brain functions. And see, to how I look at things. See, inside every person there are two people, right? So one, we have our monkey brain, which is your limbic system, and then you have your 2.0, right? I have my Ritwik 2.0, which is being controlled by my free prefrontal cortex, right? So every day it's a constant battle between my monkey brain and my 2.0, and I have made sure that 2.0 always wins, right? See, I don't want to get too much into trading psychology. It's a vast topic in itself, but I would recommend everyone watching the podcast of Andrew Huberman. Go to his YouTube channel, watch all of his podcasts that has everything to do with how your brain functions, and you'll understand a lot more, right? It is, so see, the relation between you and your brain, it should be very healthy. It should be very healthy, right? And I see, when you're trading, especially if you're very serious about stock trading, you have to understand exactly how your brain functions. You have to know what is making you greedy. You have to understand what is making you excited. Very important, right? So that being said, I wish you all the best. Please, again, like I said, um, please know that this is a very tough skill to master. So if you are very passionate about trading, please give it its own time. It'll take a lot of time. Please, so if you're coming into trading, please take a 6 months window. All right. Before that, if you're thinking, okay, no, I'll come into masterclass, I'll quickly learn something, and I'll start making money in 1 month, bro. Please, I don't want you to register for masterclass. Please, right? Have signed for masterclass, awaiting response. Okay, hey, all right, Prachi, I'll see you all. I'll see you next weekend. Cool. All right then, guys. Thank you all so much. I'm sorry, dude. My throat is kind of fucked. I'm so sorry. So thank you all so much for attending the session. I hope you all understand a lot more about the market than before you've attended this boot camp. And I wish you all the very best. Cheers, guys. Now, guys, if at all there is anything, if you all want me to break down your charts, if you all want me to go over your charts, I would love to do it. But please, you can DM me on my Instagram. It's RITVIIIK. But the thing is, please don't call me on Instagram, right? I don't know how to disable that shit, but then it kind of gets annoying when I get calls. But then I would love to go over your charts. So please DM me your charts. And also, I do giveaways constantly. So if you all want to participate in giveaways, I give away like some maybe 40-50,000 every single month. Just like that, I just do fun challenges on on this channel that I have on Discord. Sorry, not on Discord, on my Instagram. The name of the channel is Trade Breakdowns. That is where I'll be putting some of my trade breakdowns as well, right? So please try to participate in those challenges as well, right? It's fun, it's free money, right? I love giving back. So yep. So that being said, guys, I'll see y'all, all of y'all, at least some of y'all, I'll see y'all next weekend. Rest of y'all, please make sure you learn everything that I've mentioned before you step into the market. Cool. Cheers, guys. Bye bye.